Something unusual is happening in the housing market. Not a crash, not yet, but something quieter and in many ways more dangerous. Buyers are disappearing. Open houses that once buzzed with activity now sit in near silence. Real estate agents arrange fresh flowers on kitchen counters, switch on every light in the home, and wait. And wait. But the cars never pull up. The door never opens. The buyers never arrive. This isn't the kind of market shift that makes loud headlines overnight. Instead, it creeps in slowly, almost invisibly, until suddenly the entire system feels different. Because when buyers freeze, the entire housing machine begins to stall. And history shows us something important about moments like this. They rarely stay quiet for long. To understand the buyer freeze happening today, we have to step back in time. Because this isn't the first time buyers have suddenly stopped moving. In the late 1970s and early 1980s, the United States faced a housing paralysis that stunned economists. Mortgage rates soared past 18%. Imagine that for a moment. A home loan costing nearly 1/5 of the property price every year in interest. Families who once planned to buy simply gave up. Builders halted projects. Sellers pulled homes off the market. And the housing market entered a strange state economists later called a transaction freeze. Not because homes lost all value, but because nobody wanted to move. Sound familiar? Today's market is not identical, but the psychological forces are surprisingly similar. Because housing markets do not run purely on numbers. They run on confidence. And when confidence disappears, buyers vanish with it. At first, the shift looked small. A few cancelled showings. A few listings sitting longer than expected. Agents dismissed it as seasonal slowdown. Maybe summer vacations. Maybe school schedules. Maybe buyers were just waiting. But then something changed. Mortgage applications began to fall sharply. Not gradually, sharply. And that's when analysts started asking a serious question. What happens if buyers simply stop buying? The answer is more complicated than most people realize. Because a housing market doesn't collapse the moment prices fall. It collapses when transactions stop. Homes can technically hold value on paper, but if nobody is willing to buy them, those prices become meaningless numbers. And that's exactly the situation many regions are quietly approaching. Homes listed for sale, but fewer offers, fewer showings, fewer contracts signed. The market begins to feel frozen. But why now? Why would buyers suddenly step back after years of aggressive demand? The answer lies in a combination of forces that have been building quietly for years. First, there are interest rates. When borrowing costs rise, affordability collapses faster than most buyers expect. Consider a simple example. In 2021, a typical American homebuyer might have locked in a mortgage rate around 3%. By 2024 and 2025, those same loans were often closer to 7%. That difference may sound small, but in housing mathematics, it's enormous. A monthly payment can jump by hundreds or even thousands of dollars. For many families, the dream home suddenly becomes financially impossible. And when enough buyers reach that conclusion at the same time, demand begins to evaporate. But interest rates alone don't create a buyer freeze. Psychology does. Housing markets are deeply emotional environments. People buy homes when they feel secure, when their jobs feel stable, when their savings feel protected, when the future looks predictable. But today's buyers are facing something very different. Inflation has squeezed household budgets. Layoff headlines appear regularly in the news. And global uncertainty continues to ripple through financial markets. So buyers pause. They wait. They watch. And as more people choose caution, the market becomes quieter. Real estate professionals are starting to notice subtle but important changes. Buyers who once rushed into bidding wars now take weeks to make decisions. Offers include inspection contingencies again. Price negotiations are returning. And in some markets, the once familiar phrase multiple offers is becoming rare. This is not a crash, but it is a shift in power. For years, sellers controlled the housing market. Now the balance is changing. Slowly, quietly, but unmistakably. Yet the most fascinating part of a buyer freeze is what happens next. Because sellers don't immediately accept the new reality. They remember last year's prices, last year's bidding wars, last year's easy profits. So they wait. They keep listings active at optimistic prices. But buyers are no longer playing the same game. And this creates a standoff. Sellers waiting for offers. Buyers waiting for prices. A frozen market. History tells us this stalemate can last longer than people expect. During the early stages of the 2008 housing crisis, transaction volumes dropped dramatically before prices truly collapsed. Many homeowners refused to sell at lower prices. Banks delayed foreclosures. Buyers stayed cautious. For a while, the market looked stable on the surface. But underneath, pressure was building. And eventually, something had to give. Today's housing market may not follow the exact same path. But the patterns feel eerily familiar. High borrowing costs, growing economic uncertainty, and buyers stepping quietly to the sidelines. The silence at open houses, the longer listing times, the sudden absence of urgency, all small signals, but together they tell a much bigger story. Because a buyer freeze doesn't happen randomly. It happens when the system reaches a psychological breaking point. When too many buyers start asking the same question at the same time. What if prices fall after I buy? And once that question spreads through the market, hesitation becomes contagious. One cautious buyer becomes 10. 10 become thousands. And suddenly, the housing market feels very different. But here's the deeper mystery. If buyers are freezing, why are prices in many areas still so high? Why haven't sellers lowered expectations? Why does the market look stable on paper while activity slows underneath? The answer reveals something critical about modern housing markets. And understanding it may explain what happens next. Because the buyer freeze may only be the beginning. For a moment, imagine standing in the middle of the housing market today. On one side, buyers are stepping back. On the other side, sellers are standing perfectly still. And between them, nothing moves. This is the quiet standoff shaping today's real estate landscape. Not panic, not collapse, but paralysis. And the reason behind it begins with one of the most powerful forces in modern housing history: the locked-in mortgage effect. Over the past decade, millions of homeowners secured something incredibly rare. Mortgage rates below 4%, some even below 3%. At the time, it felt normal. Interest rates had been declining for years, and cheap borrowing seemed like the new reality. But those ultra-low rates have now become something else entirely. Golden handcuffs. Because homeowners who locked in those loans are now facing a strange dilemma. If they sell their home today, they must give up that low rate forever and replace it with one that is often more than double. Think about what that means in real life. A homeowner paying a 3% mortgage today might face a 7% mortgage tomorrow. Even if they buy a home at the same price, their monthly payment could jump dramatically, sometimes by thousands of dollars. So they stay put, not because they love their current home, but because moving has become financially painful. This effect is now visible across the entire housing market. Listings remain historically low. Millions of homeowners simply refuse to sell. And that creates a strange illusion. When supply stays limited, prices can appear stable. But underneath that stability, something important is happening. The number of actual sales is shrinking. Fewer homes changing hands. Fewer deals closing. The market looks alive from the outside. But inside, movement is slowing. Economists have a term for this kind of situation: a liquidity freeze. It doesn't mean assets lose value immediately. It means they stop moving. And markets that stop moving often become fragile, because prices depend on transactions. Without transactions, price discovery disappears. Nobody truly knows what homes are worth. This pattern has appeared before. During the early years after the 2008 financial crisis, many homeowners refused to sell their properties at lower prices. Instead, they held on, waiting, hoping the market would recover. For several years, the number of home sales stayed unusually low. Not because people didn't need homes, but because both sides of the market were waiting for the other to move first. Buyers waited for lower prices. Sellers waited for higher offers. And the result was a long, quiet stalemate. Today's situation carries echoes of that period, but with one major difference. The lock-in effect is far stronger now. In previous housing cycles, mortgage rates didn't swing so dramatically in such a short time. But after the pandemic housing boom, rates surged rapidly, from historically low levels to multi-decade highs. That shift created a huge divide between existing homeowners and potential buyers. One group is sitting comfortably with cheap loans. The other faces the highest borrowing costs in years. And that divide is freezing the market. Real estate agents are beginning to notice unusual conversations. Homeowners who once planned to upgrade their homes are suddenly hesitating. Families who thought they would move to larger houses are staying where they are. Retirees who expected to downsize are postponing the decision. The reason always comes back to the same question: why trade a 3% mortgage for a 7% one? For many households, the math simply doesn't make sense. So they stay. But this decision has ripple effects far beyond individual homeowners. Because when people stop moving, the entire housing ecosystem begins to slow. First-time buyers have fewer homes to choose from. Builders struggle to predict demand. Local markets lose the steady flow of transactions that normally keeps prices balanced. Even industries connected to housing begin to feel the slowdown. Furniture retailers, appliance manufacturers, moving companies, mortgage lenders, all depend on a healthy level of home sales. And when the number of transactions falls, the economic impact spreads quickly. Yet despite all these warning signs, housing prices in many areas remain stubbornly high. Why? Because sellers are anchored to the past. They remember what their neighbor's house sold for last year. They remember the bidding wars, the above-asking offers, the rapid appreciation. And those memories shape expectations. Psychologists call this anchoring bias. People base their decisions on the most recent reference point they remember. In real estate, that reference point is often the peak of the market. So sellers list homes at prices reflecting yesterday's conditions. But buyers are living in today's reality. Higher mortgage rates, higher living costs, more uncertainty. And the gap between those two perspectives keeps the market frozen. Meanwhile, something subtle is happening behind the scenes. Homes are sitting on the market longer. Price reductions are becoming more common. Sellers quietly adjusting expectations. One listing at a time. At first, the changes are small. A price drop of $10,000. Then 20. Then 50. But when this pattern spreads across hundreds of listings, it begins to reshape the entire market. Not dramatically, not suddenly, but gradually. This is how housing cycles often turn. Not with a sudden crash, but with a slow shift in psychology. Buyers regain negotiating power. Sellers become more flexible. And the balance of the market begins to change direction. Yet even now, many people still believe the housing boom will quickly return. They assume buyers are simply waiting for the right moment. But what if the hesitation runs deeper than that? What if buyers aren't just waiting? What if they're fundamentally reconsidering how much they're willing to pay? Because there is another force entering the housing market. A force that doesn't move slowly. A force that has changed housing cycles throughout history. Economic pressure. And when economic pressure builds long enough, the buyer freeze can transform into something far more powerful. A market reset. But when that reset begins, it rarely happens quietly. There is a point in every housing cycle when buyers begin to feel something powerful. Not excitement, not urgency, but resistance. A moment when the numbers stop making sense. And today, millions of potential homebuyers are reaching that moment. Economists often describe housing markets using complex indicators and financial models. But for most buyers, the calculation is much simpler. Can I afford the monthly payment? If the answer is no, the market stops moving. And right now, that simple question is becoming harder to answer. For decades, housing affordability in the United States followed a relatively stable pattern. Home prices would rise gradually. Incomes would slowly catch up. Mortgage rates would move up and down, but rarely fast enough to shock the system. Most families could eventually find a path into home ownership. But the years following the pandemic changed that balance dramatically. Home prices surged at a pace rarely seen in modern housing history. In some cities, values jumped more than 30% in just 2 years. It felt like a gold rush. Investors poured into the market. Buyers rushed to secure homes before prices climbed even higher. And for a while, it seemed unstoppable. Then interest rates began to rise. At first, the shift looked manageable. But as borrowing costs continued climbing, the math of homeownership changed rapidly. A home that once required a manageable monthly payment suddenly demanded far more. For example, a $400,000 home financed at 3% might cost roughly $1,700 per month in principal and interest. At 7%, that same loan could approach $2,700. That's a $1,000 difference every month. For many households, that jump alone makes the purchase impossible. But the pressure doesn't stop there. Property taxes have increased in many regions. Insurance costs have surged. Maintenance expenses continue rising alongside inflation. Altogether, the cost of owning a home has climbed far faster than wages. This growing gap between prices and incomes has created what analysts call an affordability wall. Buyers simply cannot stretch their budgets any further. And when enough people hit that wall, demand begins to fade. Not because people don't want homes, but because they cannot justify the cost. Historically, moments like this often signal a turning point. In the mid-2000s housing boom, affordability also deteriorated rapidly. Prices climbed faster than incomes, while lending standards loosened dramatically. At first, creative mortgage products helped buyers keep purchasing homes. Adjustable-rate loans, interest-only mortgages, minimal down payments. These tools temporarily kept demand alive. But they also increased risk. When borrowing costs eventually rose and home prices stalled, the entire system became vulnerable. And by 2008, that vulnerability triggered one of the most severe housing crashes in modern history. Today's situation is different in important ways. Lending standards are much stricter. Most homeowners hold fixed-rate mortgages, and banks are far more cautious. But affordability is once again stretched near historic extremes. That creates a difficult environment for buyers, especially first-time buyers. First-time buyers play a critical role in the housing market. They are the entry point of the entire chain. When they purchase starter homes, existing homeowners can move up to larger properties. Families relocate. New construction accelerates. The entire market flows. But when first-time buyers disappear, the chain breaks. Starter homes sit longer. Move-up buyers hesitate. And the entire system slows down. Recent housing data suggests this shift may already be happening. The share of first-time buyers in the market has dropped significantly in some regions. Many young households are choosing to rent longer. Others are moving back with family to save money. Some are simply waiting, hoping that prices will eventually adjust. This growing hesitation is one of the clearest signs of a buyer freeze. Because the people who once drove housing demand are now standing on the sidelines. Meanwhile, the psychology of the market continues to evolve. During the housing boom, buyers feared missing out. They rushed to purchase homes before prices rose even further. But today, a different emotion is spreading. Fear of overpaying. That shift in mindset can be powerful. Because when buyers believe prices might fall, urgency disappears. Instead of rushing into offers, they wait. Instead of bidding above asking price, they negotiate. Instead of competing with other buyers, they step back entirely. Housing markets are deeply influenced by these emotional cycles. Optimism fuels rapid growth. Caution slows everything down. And right now, caution is spreading. Quietly but steadily. Some regions are already seeing early signs of adjustment. Price cuts are becoming more common. Homes are spending longer on the market. Sellers are offering incentives again. Closing cost assistance. Mortgage rate buydowns. Even renovation credits. These strategies were almost unheard of during the height of the housing boom. But they are beginning to return. Because when buyers hesitate, sellers must adapt. Yet despite these changes, the housing market has not fully reset. Prices in many areas remain high. Inventory is still limited. And the lock-in effect continues, keeping many homeowners from selling. All of this creates a strange tension within the market. The pressure is building, but the release hasn't happened yet. History suggests moments like this rarely last forever. Eventually, something shifts. Interest rates move. Economic conditions change, or sellers finally adjust expectations. When that happens, the frozen market begins to move again. But the direction it moves is not always predictable. Sometimes the market stabilizes. Sometimes prices slowly correct. And sometimes the adjustment becomes far more dramatic than anyone expected. So the real question is no longer whether buyers are freezing. The evidence suggests they already are. The real question is what happens next. Will demand return once rates fall? Will sellers finally lower prices? Or will the housing market face a deeper transformation? Because the buyer freeze may not just be a temporary pause. It may be the beginning of a new phase in the housing cycle. And if history teaches us anything, it's that housing cycles rarely end quietly. Every frozen market eventually reaches a turning point. A moment when waiting is no longer possible. Because housing markets, like all markets, cannot stay suspended forever. Something always breaks the silence. The question is, what will it be this time? History offers several possible answers. Sometimes the freeze ends because borrowing becomes cheaper. When mortgage rates fall significantly, buyers regain purchasing power. Monthly payments shrink. Budgets stretch a little further. And suddenly homes that once felt unaffordable begin to look possible again. This happened after the housing slowdown of the early 1980s. As interest rates gradually declined, buyers returned to the market. Sales volumes recovered. Construction accelerated. The freeze slowly melted. But there is another path markets sometimes take. Prices adjust instead. When demand weakens long enough, sellers eventually face a difficult decision. Lower the price or wait indefinitely. At first, most choose to wait. But as months pass and listings remain unsold, reality begins to change expectations. A seller drops the price slightly. Another follows. Then another. Individually, each adjustment looks small. But across an entire market, those changes accumulate, gradually reshaping price levels. This process rarely happens overnight. It unfolds slowly, often quietly, until suddenly the market looks very different from where it started. There is also a third possibility. Economic pressure forces the market to move. Housing is deeply connected to the broader economy. Employment trends, wage growth, consumer confidence. All of these forces influence whether people feel comfortable making the largest purchase of their lives. If economic conditions weaken, the buyer freeze can intensify. More households postpone buying. Demand slows even further. And sellers face increasing pressure to adapt. Analysts across the housing industry are now watching a handful of signals very closely. Mortgage applications, inventory levels, days on market, price reductions. Each of these indicators tells a small part of the story. Together, they reveal how the market is evolving beneath the surface. And right now, those signals suggest something important. The housing market is not collapsing, but it is transforming. For years, the housing boom created an environment of extraordinary momentum. Homes sold within days. Buyers competed fiercely. Prices climbed rapidly. That era was defined by urgency. But the buyer freeze represents the opposite environment. Patience, caution, deliberation. Buyers taking their time. Sellers adjusting expectations. And the market slowly searching for balance again. Some regions may experience sharper corrections than others. Housing markets are deeply local. Cities that saw the most explosive price growth during the boom may face the greatest adjustments. Areas with strong job markets and limited housing supply may remain relatively stable. But the broader pattern remains the same. The days of effortless appreciation appear to be fading, and a more cautious housing market is emerging. For first-time buyers, this shift could eventually create new opportunities. Less competition, more negotiating power, more time to make decisions. During the housing frenzy, many buyers felt pressured to make offers within hours. Some waived inspections. Others bid far above asking price. Those conditions were not sustainable. A slower market restores something that had quietly disappeared. Joys. But even as conditions change, one truth about housing remains constant. Real estate is not just an investment. It is a foundation of economic power. For generations, homeownership has shaped wealth across entire societies. It determines how families build equity, how communities grow, how cities expand. Because housing is tied to land, and land is limited. That simple fact gives real estate a unique influence within the economy. This is why housing markets command such attention from economists, investors, and governments. When housing expands rapidly, entire economies can accelerate. Construction grows. Consumer spending rises. Financial markets respond. But when housing slows, the ripple effects spread just as quickly. Fewer home sales mean fewer renovations, fewer moving trucks, fewer furniture purchases, even fewer loans issued by banks. The housing market touches nearly every corner of the economic system. And that is why the current buyer freeze matters so much. It may appear subtle on the surface. A few fewer buyers at open houses, listings taking longer to sell, price reductions appearing quietly in online listings. But beneath those small signals lies something larger. A shift in momentum. The market is adjusting to a new reality. Yet despite all these changes, housing remains one of the most powerful forces in the economy. Its influence stretches across decades, across generations, across entire nations. Markets rise, markets cool, cycles repeat. But the fundamental importance of housing rarely disappears. Because people will always need homes, cities will always grow, and land will always remain limited. That combination makes real estate remarkably resilient. So the buyer freeze we are witnessing today is not the end of the housing story. It is simply another chapter in a long and complex cycle. A moment of hesitation. A pause between periods of rapid change. Eventually, the market will move again. It always does. But when it does, the balance of power may look very different from the boom years that came before. For now, the silence continues. Open houses waiting for visitors. Listings waiting for offers. Buyers watching carefully from the sidelines. And the housing market standing in that rare, fragile moment between motion and stillness. A moment when everything feels frozen. Yet beneath the surface, powerful forces are already shaping what comes next. The buyer freeze is not simply about interest rates or home prices. It reflects a deeper shift in confidence, affordability, and expectations. Buyers are pausing. Sellers are holding their ground. And the market is searching for a new equilibrium. History shows that moments like this rarely last forever. Eventually, falling rates, economic shifts, or price adjustments will break the stalemate. When that happens, the housing market will move again, sometimes slowly, sometimes dramatically. But one truth remains unchanged. Real estate continues to hold an untouchable position within the global economy. Because land is limited, demand for shelter is permanent, and housing, more than almost any other asset, shapes the wealth and stability of entire societies. The buyer freeze may define this moment, but the influence of housing will continue long after the silence ends.